Well, hello again, everybody. This is John Norris at Trading Perspectives. As always, we have our good friend Sam Clement, and unfortunately, Santa Claus brought a case of pink eye to our other friend, Courtney Truss. So she's not going to be with us today. We'll miss her, but I hope she gets better soon. Now, Sam, here we are at the end of 2022, and everyone had been hopeful that, after 2 consecutive years of just weirdness, 2020 with the economic lockdowns, pandemic, all that stuff, 2021 with a massive amount of cash that's sloshing about in the economy, you were hoping that 2022 would get some sense of normalcy, and I'm not sure we got it.
No, I mean, we had a bust year kind of in 2020, or I guess at least partially for the first half of it, and then just this weird, just everything booming last year.
Everything,
and it was kind of like,
it didn't matter what you did, it turned out well.
It was kind of like, okay, now we've gotten through bad times, we've gotten through good times, like as great as that
like
was.
A Led Zeppelin song.
Let's get through maybe a little bit of a normal time, and I don't think if this is normal, I don't like normal. Leave it at that.
If this is normal, I'm moving, or something, because we started off the year and it just, gee whiz, money is so easy in 2021. January started off bad, and then all of a sudden, Moscow decides to invade Ukraine, and that just caused the markets to flummox. The dollar goes through the roof. Federal Reserve starts cranking up interest rates. Inflation is all through the roof. Everyone's worried about inflation, worried about the Fed. Will the Fed kill the economy in order to kill inflation? And at points during the year, it seemed as though we were trying our best as a global society to tear ourselves apart at the seams.
Really, a lot of this year kind of seems like a nightmare.
Unless you were long, just Exxon or some other energy companies, it was hard to make money in the markets this year. And you're right, Sam. So much of it was pretty much a nightmare. I mean, clearly, I've been doing this for a little over 30 years, and I've told everyone that will listen, this has probably been the most unpleasant year that's been in my career. Because, at least in 2002, something worked. And that's the worst year of the tech sell-off. Something worked. If you're in regional bank stocks, okay, that's fine. You did okay. But the bond market rallied, and so you could avoid having a disastrous year.
Sure.
In 2008, that was pretty bad. I mean, that was pretty bad too. But, you could buy some long treasuries, something like that, and escape maybe some of the worst of it. This year, really, with the exception of energy stocks, there was no place to go.
No place.
Absolutely no place. When the bond market's down double digits throughout much of the year, when virtually everything is down 15 to 20%, again, with the exception of energy, it is just hard to construct portfolios that will do anything other than lose money for your clients.
Right, and if anything, the best year to compare this year to in terms of the markets has been 1931.
Listen, I'm not that old. If Courtney were here, she'd say that, do you remember then, John?
Yeah. But, that's a long time ago. That was obviously an awful time to be.
91 years ago.
Yeah, that's an awful time to be in the markets as well. And that's really the best thing we have to compare it to. It's really not normal for longer-term treasuries, these kind of safe haven assets, to be at times this year performing worse than the stock market. And it's really, I mean, I think you could very easily justify calling this a kind of black swan market for how unique this is and how the awfulness and everything. I mean, inflation was bad, gold was bad. I mean, nothing's worked.
I mean, it really was a bizarre year when you're right. Historically, inflation and the dollar move in opposite directions. Historically, that's a negative correlation between inflation and the strength of the dollar. Unfortunately, this year there's a very strong positive correlation because while inflation was hitting 40-year highs, the dollar was hitting 20-year highs.
Yeah.
And as a result, gold didn't really know what to do.
Yeah.
I mean, typically gold is a hedge against inflation because of dollar weakness.
Yeah.
Or what do you have when...
And real interest rates.
Yeah, real interest rates. And what happens when these things don't work out?
Yeah.
Gold couldn't figure out what to do.
Real interest rates soared, and that's typically not great for an asset that doesn't kick off any sort of income
it just kind of
or do
there.
anything. Yeah. So I guess that's not completely unique to gold, but real yields going up is typically not great for things.
It's been tough on real estate. It's been tough on most things, with the exception of, again, crude oil prices, although those have moderated
and they're down
lot.
for the year now.
Yeah, down for the year. And so it's been a troublesome year. So here we are, next to last week of 2022. I've got to ask you, did you learn anything?
What
did you learn this year in 2022?
I think looking at it and being able to only compare this to 1931, which neither of us were around for.
Not even close. Don't look at me like kind of quizzically.
It's like,
my father wasn't even around. Come on.
But no, I think, seeing markets like this, I think when people, or when humans in general go so long without experiencing something like this, it can kind of reset the expectations for what does happen, what can happen. And I think part of what I guess I've learned is how long, these kind of awful markets can go on. And it happened in '08, but that was a little more justifiable or understandable. I mean, the financial system was about to collapse.
Yes.
But a year's worth, pretty much without reprieve. I mean, some slight breaks, but about a year without reprieve of a miserable market. And
miserable markets.
Yeah, globally, anything, everything, pretty miserable. Just the length of time that it can go on. And
it's, in hindsight, I guess I learned when the Fed takes the punch bowl away, leave the party. I mean, leave the party pretty quickly. But Sam, you know this. It's a difficult situation that a lot of investment managers and others were in this year, and they would tell you this, and clients probably aren't terribly happy about it. We realized massive gains. All institutional investors realized massive gains to their clients in 20 and 21. And this year, it's a sticky wicket. Do we go ahead and realize massive capital gains tax bills for our clients just to avoid some short-term underperformance? Or do we hold on to the stocks and let the market values go down? And so it's a tightrope because clients aren't going to be happy, investors aren't going to be happy either way. It's a negative year, and then you get a big tax bill.
No one wants to pay taxes when they're losing money.
No one wants to do that. So do you avoid the worst of the worst? Maybe have down -5%. You're still bleeding a little bit, but not as bad as the market. But then you get a big tax bill in April, or do you down 10-15%? But then actually your investment advisors have generated some losses in the portfolio, so your real after-tax return is closer to 5%.
Yeah.
So, what do you do? It's 6 of one, half dozen of another, and here at Oakworth Capital Bank, again, our caveat is that this is not an offer to buy or sell securities. We realize a lot of losses late in the year for our clients in order to avoid that sort of April 15 shocker that would really make people unhappy.
It's probably the one thing or I guess the easiest thing to control in a year like this, I would say, is realizing losses. It's, again, I mean, we've all said it all year that there's probably not much worse in the investment world than paying a big tax bill on a year where you lost a lot of money.
No, that sucks.
And so that's really, I guess, the best way to kind of mitigate that is figure out what kind of losses you can realize. Yeah. And, I think that's something that everybody's had the opportunity to this year when there's about no portfolio. I mean, you could be in a 20% stock, 80% bond portfolio,
and you're still
getting hammered this year. I mean,
and hammered not in a good way.
Not in a good way, yeah.
You're getting hammered in the portfolio makes you want to go out and,
get hammered.
Yeah, there you have it. Yeah. That's kind of juvenile, sort of, in any event.
Nonetheless.
Yeah, I also learned this year, apart from the markets being screwy, is that the world seems to be suffering from a lack of effective leadership. And that's just me talking. That's not necessarily the opinions of Oakworth Capital Bank, any of its associates, all that good stuff. But the world seems to be suffering from a lack of effective leadership. And this is, I think, evidenced by polls that various places like Pew Research have taken the American public, just saying that confidence in our nation's institutions, all of them, are way down. Whereas small business, what'd you say a couple months ago?
Like, who doesn't like
mom and pop? Well, about 30.
I don't trust them anymore.
About 35% don't trust them. But respect for the military has gone down. Respect for the presidency, the Congress, the Supreme Court, and really big business just in general. And that really, I think, points to a lack of effective leadership. It's not just here in the United States. You take a look at what's happened in Europe. I mean, good night. I mean, Macron wins, but then all of a sudden he doesn't get anything in their legislature. I mean, it's topsy-turvy over there. We've seen Britain, the mess that has been Britain. I mean, we had that PM for four weeks.
Yeah. Head of lettuce lasts longer. That was in the news in England.
Liz Truss, and now this next one coming up. I mean, he does away with pro-growth, plans and goes back to the tried and true, which put UK in this mess in the first place. Italy elects a far-right individual, and then Moscow goes back to being the Russians go back to being Russians and invade the Ukraine. I mean, it's just a mess. We see China, looking inward, becoming more bellicose, threatening Taiwan. Xi is now president for life. Might as well call him the emperor. North Korea is sending missiles out like nobody's business. Lord knows where they get the money to pay for all those missiles. Maybe a bunch of counterfeit $100 bills. I mean, who knows? But it just seems here at the end of 2022, with all the hopes of this year being a year of somewhat normalcy, we're actually maybe a little bit more fractured than we were when we started the year.
I think this year was less normal than either of the past 2 years.
Okay. I want you to elaborate on that just a little bit.
I think by normal, I think that means, I think you can say, okay, these are the things that have happened, and this is the reaction to it. If that makes sense, that seems relatively normal. And I don't mean, obviously a global pandemic's not normal in the sense that it happens every year, but the reaction to it, I guess, was really somewhat expected at least, or you understood why things were happening. People understood why the markets were going down just dramatically.
People got it.
Makes sense. The Federal Reserve stimulates the economy. They throw tons of money at it. The government stimulus just being tossed out of helicopters, pretty much. I mean, just direct deposited into people's accounts. So
cold hard cash.
Spending goes up. I mean, online e-commerce goes up. All that makes sense. Interest rates are still at zero while this money is still being thrown into the economy for the better part of 18 months.
Yes.
And so the reaction on the flip side of that makes sense as well. And I think this year makes less sense than...
Well, I mean, nothing seems to... I mean, I've told plenty of people that the data this year has been incredibly weird. For instance, we've had 2 negative quarters of GDP, first and second quarters. You break down the data, and it maybe wasn't as bad as the negative numbers suggest. There's just some way that the...
just net exports.
Yeah, net exports, changes in inventories, which is kind of mitigated by some other things. It's just the reports themselves weren't as bad as the negative numbers. However, then we have a third quarter report, comes out 2.6, 2.9%. You break them, hey, things look great. I mean, I'm sure Washington's running the flag up the flagpole.
Right.
However, when you break down the numbers, it just really wasn't that good.
And I think that kind of buys into what we've talked about and not buying the back-to-back quarters of GDP being a recession, because it all depends on what's actually in the data and the story that's being told by it.
Without a doubt. But even so, this is slower economic growth, which we predicted. I mean, there's no way you can grow 5.9% or whatever we did, or 5.6, 5.7% in 2021 and not have a relative slowdown in some form or fashion. But even with the economic slowdown, businesses are still saying they're having a hard time finding workers.
Yeah.
And so while the economy is posting these, let's just say, no growth numbers, businesses are still struggling to find workers. At some point, that too, Sam, has to turn over.
And I think that's something that the Fed is kind of, honestly, they're not going to bluntly say it, but they're kind of hoping people lose their jobs. I mean, they've expected...
I'm not sure they said it.
No, that's what I'm getting at, is they said it. I mean, but to people who don't follow it, don't know that. But they've said, I mean, they expect unemployment to go up. They need unemployment to go up.
And that's when, in reading and hearing Jay Powell's comments when he was talking about that, it just, another thing that I learned this year is no matter what you think about the Federal Reserve, positive or negative, they're academic bureaucrats.
Yeah.
Because here Jay Powell was sitting there talking about unemployment, going up. It anticipates this going up. Their actions are going to drive the economy down to a 0.5 growth rate. Unemployment kicks up, all that type of stuff. It sounds fine in terms of spreadsheet work. When the numbers are data points, black and white, or colored dots on a computer screen. However, Sam, those unemployment numbers represent individuals. They represent families. The low economic growth reflects food on the table, access to goods and services. So that is another thing I learned this year, that sometimes our policymakers live and operate in a vacuum and not necessarily the real world. Your thoughts on that?
Yeah, absolutely. I mean, we've talked about it that, oftentimes, and the Fed has been shown to be wrong at times in their projections. I mean, it wasn't too long ago they were expecting, strong GDP growth, very little inflation this year, and just overall kind of a pretty solid year. 3 rate hikes of 25 basis points each were their projection for 2024, so 2 years from now.
Yeah.
And instead of that, we're getting over 5 points of hikes in less than 12 months. And so these projections can be very, very far off. But I think it's also interesting, we've had so much contribute to this inflation. And I would say the quantitative easing that we've talked about the Fed doing is very low on the list of what actually caused a lot of this inflation. I mean, to put it simply, that's swapping dollars around on balance sheets. It's not printing money.
It's not printing money. It's creating the potential for money creation
for loans.
Yes.
Yeah. But meanwhile, we had, the federal government literally direct depositing money into people's accounts.
It's a modern equivalent of turning on the printing press.
Printing press. That is actually printing money. Yeah. We've had quantitative easing since the early 2000 or late 2000s. Over a decade of quantitative easing, and we couldn't even get to 2% inflation for most of this time. Hard to argue that's the cause. And then we shut down supply chains, artificially boost demand through what is printing money, and that is a perfect storm for actual inflation. And that's what we've seen. It's come out with a vengeance. That is money, that is true money into the money supply.
There you go. And what we just read about just passing in Washington? Another $1.7 billion or trillion?
Trillion, yeah.
So it's as though the powers that be can't learn from their own mistakes. You dump a bunch of excess cash into the economy, guess what happens? Inflation goes up. Then you have to raise interest rates and kill the economy in order to get inflation down. So what we
have more debt at a higher level.
More debt at a higher level of interest, and it's just kind of shocking to me. It just how much that, again, that's going kind of thinking about it. The more I've learned, the biggest thing I've learned this year is how the powers that be, the so-called experts, the adults in the room, really are completely winging it.
And how much did they drop the ball not raising debt at the interest rates of?
Listen.
18 to
you and I talked about that. They should have gone out and floated some.
A 50.
Yeah, a 50.
100.
100. They should have gone out and do a 200-year at a 2%.
Find some insurance companies need a little duration.
Yeah, they need a lot of duration with that bad boy. But the thing about it is go out there but instead they keep on rolling bills. And now, Lord knows what our debt service is going to be next year, but you throw another close to $2 trillion of new expenditures on top of that. At the same time, when tax receipts will be going down, we're going to see a lot of problems with the deficit in Washington. If not 2023, 2024 is going to be a mess.
Yeah, it seems like consumers maybe knew to take out longer debt than the government did at the time. We saw the boom in mortgages and everybody locking in.
Yeah.
15 years, there was even more 30 years.
Listen, there is no refi activity going on right now.
It's done. The only people who would possibly refi right now would be in an emergency, I need cash situation.
Yeah, a wedding to pay for.
Yeah, even then, that has to be the last resort, giving up a low interest rate to lock in a high interest rate for 30 years. Truly a last resort.
So are we trading perspectives here at the end of this podcast about what we've learned this year? We've learned this year, I think we both said, this year was screwed up.
Expect the unexpected.
Expect the unexpected, and expect that the people that are making policy for us really don't know what they're doing.
Who said that quote about markets being able to stay irrational longer than you can stay solvent? Or somebody, and while solvency was the word used, it may not be the most appropriate for what we're talking about. But I think the point is valid that markets can remain pretty irrational for a long time.
That's another thing you learned. All right.
That is.
There you go. Well, guys, we always love to hear from y'all, and hopefully this didn't depress you too much, at least what we learned here in 2022. But this has been a pretty challenging year. I think we all agree on that. In any event, we always love to hear from you all. So if you have any comments or questions, please, by all means, let us know. You can always drop us a line at tradingperspectives@oakworth.com, or you can leave us a review on the podcast outlet of your choice. As always, if you're interested in reading more, hearing more about what we have to say or what we think, please go to oakworth.com, take a look underneath the Thought Leadership tab for all kinds of exciting information. Sam, anything else you want to share about what you learned this year?
That's all I got.
That's all I got today, too. Y'all take care.